Okay, good. Right. Hello, everyone. Welcome to today's webinar in collaboration with the Financial Analysts Journal. I am Robert Farrago, and I help to organise this series alongside Gerhard. I head up thought leadership at Aberdeen Standard Investments. Today's topic is the rising role of ESG analysis in institutional asset management. We know it's rising, but we don't entirely know why, and we don't exactly know how asset managers are using this analysis. In today's webinar, we have invited Professor Amir Amel-Zadeh to present his paper, Why and How Investors Use ESG Information, Evidence from a Global Survey, which he co-authored alongside Professor George Seraphim from Harvard Business School. The survey captured responses from managers accounting for over 40% of institutional assets under management around the world. So this is an important paper on an important issue. Amir is Associate Professor of Accounting at Said Business School at Oxford University. His research examines the economic effects of financial and non-financial reporting. He is also interested in the consequences and interaction of accounting and capital regulation of financial institutions. Prior to joining Oxford, Amir taught at the Judge Business School at Cambridge University, picking up an award for his teaching, having previously won an award for the best PhD in social sciences. Amir also worked at Lehman Brothers in London. Before I hand over to Amir, can I ask you, the audience, one question? This is a question that appeared in the survey, and the question is, are you an ESG specialist? So does your job title or your job description really focus on ESG investing, or would you, if not, would you count yourself as a generalist? While you answer, let me hand over to Amir. Amir, over to you.
Thank you, Robert. Thanks. It's a pleasure to be here and to talk about my work and discuss a little bit this paper and the idea behind it, but also give you a little bit more color on some of the issues that didn't make it into the paper. So in the editorial process, we kind of weed out certain details and maybe then have the chance to answer any questions that are on the paper or any issues around ESG. So it seems ESG is becoming an important topic, and there's growing demand and understanding what we actually mean with ESG, and in particular why investors use ESG information, how they do it in the investment process, and this is essentially this project that we embarked on. Before I go into the details, let me give you an overview of what we have done. Let me just switch the slide. All right. Okay. So the paper essentially summarizes some of the results we have from this survey, and this is just part of a much larger survey project that we embarked on with BNY Mellon a couple of years back. And essentially, the idea behind it was to understand both the issuer side, but also the investor side, and along various dimensions of ESG. And this particular paper focuses now on the investor side, but I'm currently working on one or two other papers that in particular look at climate risk, which is also in the headlines at the moment, but also on the discrepancies in disclosure behavior versus what investors actually want to hear from companies. So the survey, we try to be careful with the survey, given that generally surveys, there's certain issues we have in terms of who answers surveys, so whether we are biasing responses given the topic specifically, that we have more people inclined that are inclined to or interested in ESG, answering obviously a survey on ESG. So we try to get responses from a broader set of institutions also those that maybe don't have any allocation in ESG or any interest in ESG, and also from a broader set of respondents, so individuals that are not necessarily ESG specialists, so from senior management of these organizations to get a sense of the opinion of the organization as a whole. So in preparing the survey, we essentially went through a couple of beta tests with a small advisory council, both on the corporate and on the investor side, but also with academics to make sure that everything is okay. And in general, so the survey instrument, so the actual instrument, the online instruments that we sent out was managed by Institutional Investor Research group, who essentially collected and assembled the raw data that they then passed on to me. As I said, this was a larger survey, so there were around 30 questions, admittedly a bit too long, the survey. I had some feedback afterwards that definitely I shouldn't expect investors to answer all of this. Well, I only had one chance, so I made the most of it. So, which means that I essentially had, including sub questions, around 420 variables now that I can analyze in terms of and around ESG, and this is what essentially I embark on now, and part of it is in this paper. So I think we got a good survey response rate. So the problem always with surveys is that response rates are relatively low. So in our case, we had a response rate of 14% overall, but also with a caveat that for specific questions, given that we didn't force people to answer questions to proceed in the survey, obviously respondents could skip questions. So overall, for individual questions, the survey response rate sometimes is as low as 8%, but still this is in line with general survey responses.
And I think it's worth pointing out that although it's 14% response rate, your coverage was very high, so you clearly picked up the major.
Yes.
investors.
So in terms of assets under management, maybe I'll go to the next slide that essentially shows this. We capture roughly 40, I think it's 42% of global assets under management as of year-end 2015. And as you can see on this slide, so we cover around the biggest response rate is from asset managers, around 423 responses, and which is around 24 trillion in assets under management. So if you were to look, and in the paper we've given some more demographic information around the sample, also geographically and by the type of organization, so you can have a bit more if you're interested. But generally, so the 14% response rate and 40% value weighted means that we essentially got responses from a host of really large organizations in this space. Good. So let's delve into the details.
Yep.
Let me just talk a little bit about the geographical spread, because I think this is important. This was definitely important to us, that we capture a variety of geographical regions in terms of investors, but also for the issuer survey. And as you can see, so we got a good spread of North American and European asset managers and asset owners, so the gray and the yellow circles here, but also then Asian investors and Middle East and Africa. So in terms of distribution, I think it covers roughly what the distribution generally over the whole population of asset managers should be around the globe. Good. So, as I said, so if you wanted more detail in terms of the actual numbers, there's a lot more detail in the paper. I'll also be happy to provide more detail, and if you have any questions. But I thought it's better to get the main message and the main findings out. So, first of all, what we try to understand is just in general, do investors consider ESG information in investment decisions? In the survey, we provided a definition of what we understand under ESG to make sure, and we essentially said it's it's the same as non-financial information in general. So we wanted to capture the broader view, which is then not surprising that the vast majority of investors essentially responded that they do take ESG information into account in their investment decision. But this doesn't necessarily mean that these investors use specific ESG strategies. It's just that in general they are taking ESG information in whatever shape or form into account in investment decisions. And I think one interesting observation here is that Europe and essentially the rest of the world, the considerations for ESG are a bit higher than in the US. Although statistically there's no big difference, but I think just from the numbers economically, we can see that there's a bigger difference. So European investors are more inclined to look into ESG information when making the investment decision, and this is also true for investors that are larger, so probably have the resources to essentially dedicate to ESG. So I think from this perspective, there's nothing surprising here, but that there is a slight geographical difference. So I think more interestingly is then so this was part of one question. So when investors responded that they do take ESG information in their investment decisions into account, then why do they do so? So we want to understand what is it really that makes investors take this information into account. And I think here, so I just plotted some of the main findings here and the differences between US and Europe. And what I found surprising, maybe positively surprising so, is that the majority of investors do take ESG information into account because they believe this information to be material to investment performance. So financially material. And there's a slight difference between US and European investors. So more European investors take ESG into account because of their financial materiality. But again, these differences here are not statistically significant. What I think is interesting is when you go further down this graph that there are significant differences in the other motivations why ESG matters for investment decisions. And this is one is that significantly more European investors say that it is effective in bringing change at firms. And I'll show you later the results on the styles that investors use. And so Europeans are more likely to use an engagement, more an active ownership approach on ESG using ESG data. Interestingly, is that U.S. investors are more likely to use ESG because it's part of their investment product strategy. So I think this just reflects that even though some of these U.S. investors don't believe that it's financially material, they still essentially offer ESG products because of demand for these products in the market. So I think that's an interesting point.
And investors could tick multiple boxes for this one, presumably?
Investors could tick multiple boxes, yes. So in the questionnaire for this question, you could tick whatever motivation you believe. So this is why the percentages don't add up to 100%. Except you could, of course, also. So if investors initially said that they do not take ESG information into account at all, then they would not be able to choose one of these. But then I'll show you the results why they don't take ESG, what they said they don't take ESG information into account. Interesting here, I think, is also that, and I think we know this, is that European investors are also more inclined to use ESG because they believe it's an ethical responsibility. And they have an ethical responsibility to do so, and there's significantly more. If I had given you a little more detail here into the type of organizations that responded, there's significantly more asset owners that have this as an ethical responsibility. And if you really dig even deeper, one level deeper, we see that there's some norms-based investors that take this as their motivation to take ESG into account. So I think generally we can say that the majority, there's an agreement, even though there's slight differences, but there's an agreement at least between US and European investors, or the majority of them, that ESG information is material to investment performance. And I found that well, positively surprising, but I think it needs a little bit more explanation why that is the case and what exact information investors believe is material to financial performance and how. And essentially we'll delve into the details on this as well. But before going into the details of the financial materiality, let me just show you the responses on why investors do not consider ESG information. So those that responded, what was it, 18-20% that responded that they do not take ESG into account. We also wanted to know why they don't do this. So is it because there's a belief that it's not financial material? Is it the data quality? What exactly is it? And so here it's not that clear what there's no one particular factor that is driving this, but if you look at the first three responses, so they get equal percentages, especially for the US, is that in the US, at least, investors believe that there's no demand for such policy. So there's no demand from their constituents or from their asset owners, if they are asset managers, to take ESG into account. There is, and also the same equal proportion believes that this ESG information or non-financial information is not material to investment performance. And here, interesting is the stark difference between European and US investors. So a significantly higher proportion of US investors essentially said that they don't believe ESG is financially material. I think this potentially explains the wider spread of ESG strategies and uptake of ESG in Europe versus the US, which is still lagging behind Europe in all aggregate numbers.
But the percentages are all much lower. Is that essentially were there a lot of people who didn't respond then?
The percentages are much lower because the spread the spread is much wider, and so there's and some people just didn't respond why they don't take this into account. Also interesting, so the third point here, again, big difference between US and European investors is this, what has back then in 2016 when we did the survey still been a confusion, particularly with asset owners, around this fiduciary duty and ESG. And a significantly higher proportion here of US investors at that time still believe that taking ESG information into account would violate their fiduciary duty. Now, we found that somewhat surprising because just a couple of months before we opened up the survey in the spring of 2016, in December 2015, essentially the Department of Labor back then sent out a clarification that it's not, that taking ESG information into account is not a violation of fiduciary duty as long as it's used as kind of a tiebreaker when you take financial information into account, and then if it doesn't detract from the financial performance, you can also take into account ESG metrics in your investment decision. But obviously, if one links that back to the response that the large proportion of US investors do not believe that it's financial material, and also that it's might even be detrimental to financial performance, that also then explains why they believe it's a violation of fiduciary duty. But since then, I think things have changed, although I think recent changes in the Department of Labor have moved again back to a focus on more financial factors. Interesting here is also that a significantly higher percentage of European investors say they do not consider ESG information because they lack access to reliable non-financial information. And so data access, and particular access to reliable information, is a big issue. And we also dig a little bit deeper into this question of what essentially impedes taking ESG into account. And data quality has been a big issue. I think there's been some progress on this, and we can talk about this as well. But at that time, it was definitely in the minds of the European investors. Otherwise, there's not big differences, other than again that this financial materiality plays a bigger role for European investors compared to US investors. So what didn't make it into the paper, but I thought it might be interesting to show, is to also then understand why investors believe ESG information is material. And I have a lot more results that go into depth on this question that I'm trying to write up in another paper, but essentially to give you some sense of what it is, what ESG reflects, is generally speaking is a reputational, it's reputational or headline risk. So the majority looks at ESG as a signal for some underlying latent risk that ESG essentially makes more transparent. And in particular, investors believe that ESG affects a company's reputation and brand. It's the majority one, and also might tell investors something about potential litigation threats and regulatory interventions. So, and I think this is interesting. The second interesting area, I think, is that some investors also believe that it signals some good management. So it's a signal for either long-term management or higher management quality in terms of how generally managers lead the company. And we went into a little bit more detail here, but it's generally reflects back on the short-term versus long-term managing the firm for short-term quarterly results, or the long-term shareholder value. So this is essentially what seems to be driving this. So here the percentages are very high. Actually, I mentioned it as I aggregated those answers that essentially answer that they agree to this statement or strongly agree. So this was an answer over a 5 scale, Likert scale, from strongly agree to strongly disagree. But you can see that it's heavily tilted towards agree or strongly agree on these points. So moving on, in terms of the data quality issue, we asked investors what essentially hinders them to integrate ESG in whatever form it is. And I think the biggest hurdle, as the results suggest, are a lack of comparability. And with a lack of comparability comes essentially a lack of standards. So it seems like that a lot of investors would benefit from some form of reporting standards around ESG. And there are developments around this. I think it's slow, but there are developments around this. And for the interested, I think there's an Oxford Union debate on this in December, where we have the standard setters and other to debate whether the standard setters, so the ISB or the FASB in the US, should be responsible for setting the standards for this, or whether it should be other organizations. So I think there will be an interesting debate. So generally, having comparability across firms is helpful, but it's also that and I think that this is in line with that answer, is that there's still a high cost of actually getting this information. And there's of course all these data aggregators and different data providers that provide this information. But in talking to investors, some of this is too infrequent. Sometimes it's not comparable across firms, and often it's too highly aggregated and to be meaningful, it seems. So these disclosures are too general. But investors have responded that so the majority actually use data providers instead of going directly to the disclosures of the company, so to the sustainability reports or even financial reports if the information is in there. So so I think there's still a lot to be done on the data front, and to enable investors to take ESG information into account. And I will talk a little bit about this later, what this means for the strategies or the styles, as we have called them, that investors have used in the past, because certain styles just do not lend themselves to be implemented if you don't have the quality data to do so. So, and this is reflected in the styles that investors use. So we will see that later. But what I thought is also interesting, again, this didn't make it into the paper. Let me just quickly go back on this slide. Is if you look at so comparability is an issue, but the issue with ESG data in particular is that not all ESG information is material for all firms across sectors, which means that it's a bit more difficult in this domain to require all companies to disclose a certain metric as we would do in financial reporting, because these metrics are not the same across companies, or might not be the same, and might not be similarly important across companies. So, and we try to understand this in asking, and apologies for the error in the headline here. It should say which ESG information is material for which sector. So we try to understand. So now across the sectors that are in the heading of this table here, so you have in the columns, you have from basic materials, industrials, energies, utilities, to all over to professional services, financial services, and then tech and media. We try to understand, given more broader environmental, social, and governance aspect, and we kind of summarize some, but I have a lot more detail on specific metrics as well, is what investors believe is material for the different sectors. And the lighter the shade here, the higher the impact, meaning the more material, or the more investors have responded that this is material for that particular sector. And you can see that the gray highlighted two areas. So on the social, it's employee policies and practices, and governance, general governance is essentially material across the board. So investors believe there's certain ESG factors that are material no matter what company you are. And governance makes sense, is leadership policies, tax policies, transparency, board diversity, and so on. This is all material across the board. And similarly, when it comes to employee policies and practices, again, employee diversity, training, retention, this is important across the board. But then certain other ESG factors are not necessarily material for all firms across all sectors. So if you look at the environmental, for example, again, makes sense that there's kind of a split. And you can see that on the left side, we have all the more resource-intensive sectors, as basic materials, industrials, energy, and utilities, for whom climate change impact, energy and water consumption is material, as investors have responded. Whereas for professional services, consumer and retail, or tech, these environmental issues are really less material, as perceived by investors. And similarly, there's some differences in terms of the social factors. So here it's the other way around, that, for example, for tech, media, and telecom, of course, data privacy, as we had, again, a couple of media headlines around data breaches, is found to be material for these companies, versus in the energy sector, maybe less. So this essentially tells us that if we wanted to get to a stage where we have comparable information, we need to be a bit more differentiate a little bit more around what is actually material for specific companies to make it also to enable investors to assess that information that is particularly material for those firms. And to some extent, it's also part of it should also be part of the disclosure strategy of firms to highlight only the material factors versus the immaterial ones, which I think at the moment is not the case. Then, so how do investors integrate ESG information? Now, I have kind of summarized a couple of tables from the paper into pretty much two graphs here. So one is this one where essentially we try to first understand currently, so at that point in 2016, what are the ESG strategies or styles that investors use predominantly, and it seems, as you can see, so a large fraction uses ESG in form of an engagement strategy or active ownership, so engaging with companies on ESG issues to change company policies. The second largest response here was integration, so that investors actually use ESG in a fully integrated style in assessing risk, whether it's for projecting future cash flows or whether it's as part of in the cost of capital, but it's kind of an integration approach. And then, of course, we have negative screening, thematic investment, so as part of a particular, let's say, green bonds or a particular theme, renewable energy theme. And then we have certain other strategies, positive screening, relative screening, so best in class type, and risk factor or kind of a smart beta strategy is less or was less used at that point. What we did in the paper, and there's a bit more detail on what essentially which motivations are more correlated or higher determinants of these different styles, and you can read that in the paper, but just to give you a sense is that it looks like that those investors that are more financially motivated in terms of that responded that they believe ESG is financially material, they're more likely to use in engagement and an integration approach, and also to some extent positive screening. Those investors that responded that it's an ethical responsibility, they are more inclined to use a negative screening strategy, which makes sense because generally norms-based investors have used negative screening to screen out certain sectors or industries, and without regard or with less regard on the financial return implications of that. So so we can, in the paper, we delve a little bit into detail into the determinants, what determines investors to use one strategy versus the other. Here we also see that those that have responded that data quality is an issue are less likely to use an integration approach because data quality matters for you to make a better assessment and actually be able to integrate ESG into your investment strategy. Now, lastly, I would just would like to point out this slide. So here I have tried to summarize two questions into one graph, and I think this is quite telling. So what this graph essentially shows is we asked investors about what they believe is what these different investment styles, what the impact is on returns. So this is here on the x-axis, and I normalized everything to the mean score. So everything that is to the right has a higher or is more positive in terms of its impact on returns than the average strategy, and everything to the left is more negative. So that's on the x-axis. On the y-axis, it's essentially the response to the question which of these strategies are more likely to be used in the future, and in the future we said within the next 5 to 10 years. So higher up is more important. Investors believe it's more important in the future. Lower down is less important. And then I split this between asset owners and asset managers, so that I think there's some differences here. But what you can see is, so in the upper right hand corner are those strategies that are believed to have a more positive impact on returns and also be more important in the future. And you can see this, there's essentially three strategies. So integration, engagement, and positive screening are essentially those strategies that investors will be using more in the future, and also believe that they have a larger impact on or positive impact on return. There's next, I would say, is risk factor investing. So I think we've seen that there's a growing development of kind of smart beta strategies and using ESG as form of as similar to a value momentum as a factor. On the left-hand side, you can see that negative screening is essentially believed to have a negative impact, or more negative impact, relatively speaking. So in absolute terms, negative screening was still said to be around no impact, but relatively speaking to all others, it's more negative. And this is what this graph shows. And it's also, but still, asset managers believe this still to be fairly important in the future as well. And I think this shows essentially two things. So one is that generally it's easier to use negative screening methods if the data quality isn't great, because you can screen on certain more aggregate scores than actual details, and maybe as a belief that this strategy is still going to be used in the future, but also it is because norms-based investors use this kind of strategy. But it tells you, I think, so this graph essentially tells you something about that we will see a growing importance of more data-intensive strategies, except maybe for engagement, although you can, I guess you need good quality data on engagement as well, but for integration and screening purposes. And this is why I think we need to aid investors in being able to use these strategies that are also believed to have a positive impact on returns. So I think there was a quick pass and summary of what is in the paper. Hopefully this gave you a good glimpse of what we're trying to achieve with this. And I think there's more to come as well. I look forward to questions.
Well, we have our first question in. So from Sam, from page 12, which is the one we're on, you think managers attribute more importance and assign higher impact on returns for all factors compared to their owners. Why this pattern all round, especially on the impact? Is this related to how the questions may have been framed?
Yes, that's right. So this was somewhat surprising to me too. So if you look at essentially the orange colored marks, they are always more to the right and always more up than so asset managers essentially attribute a more positive impact than asset owners. I think this has generally to do with asset owners having been more skeptical around ESG, or some asset owners having been more skeptical around ESG strategies in general. But I think to really be fully able to answer this question, we'll have to look into the composition of asset owners and asset managers that reply to this question. So I wouldn't be able to. I don't think it had to do anything with the way the question was framed, because so this is just an aggregate of two questions, but it might have to do with the type of asset owners that responded to this compared to asset managers.
It could be about incentivization as well, that asset managers are incentivized to believe that ESG is going to lead to higher returns and be more important.
Yeah, so we can look into this. That's right. So in trying to understand what the motivation is, so do they truly believe it's financially material, or is it because, as we had in one of the earlier questions, whether it's a product strategy? So it's essentially it's a strategy that so it's an incentive to supply these kinds of products. So I think there's a
Can I ask, when you talked about selection bias, do you think in terms of the people who answered, the people who answered
yeah.
are naturally going to be interested in ESG as a topic? So you sort of picked the cream of the crop.
Yes, so this is obviously always a concern with surveys. So, and we try to assess what that bias would look like. So, for one, I think what gives us confidence first is that that we have 40% of AUM, so which is of global AUM, which gives us a fairly large. So if already, even if those 40% are those that are interested in ESG, I mean, that tells us something, that it's already 40% of AUM that is of global AUM that is interested in ESG topics. So, so secondly, in terms of the type of respondents, we looked at those that so we asked them about their ESG allocation, so whether they have ESG funds or any ESG allocations. So even if we dial down on the ESG allocation, so for those investors that responded, they have zero ESG allocation. Even among those, there was 65% still responded that they take ESG into account in their investment decisions and find it financially material. So I think that's one. The second, which still tells us that there is and I mean, to be transparent, I think there still is a positive bias in here to some extent, of course, and we can't do anything about this. But what we also found out is that so we gave respondents the choice to provide their identity essentially, and or not. And if you look at the difference in respondents between those that provided their identity versus those that didn't, we see that those that didn't are also more likely to respond slightly more negatively. So that tells you something, that there might be a little bit of a reputational issue in there as well. But
yeah. Okay. Do keep your questions coming. We have another question from Sam. Could you help us understand the high-level asset owner mix following on from the above question? So
yes.
How was it split between insurers, pension funds, between passive and active? Can you give us a feel for that?
Yes. So in terms of passive or active, it was a mix, I think, generally. So we asked them whether they use a passive, active, or have essentially both. So, but it's roughly 60, I think it was 65-35 in terms of active and passive management. But in terms of the type of organizations, so we had around 30% of those asset owners are, so 13 are corporate pension funds. We had around 6% public pension funds or local authority pension funds, and then some. And this is not of the asset owners, but of the total respondents. So 13%. You have to then calculate how much is that of the asset owner, of the 35% of asset owners that responded. But so in general, the majority is corporate pension funds, then public funds, then some endowments and insurance companies. And financial institutions are essentially the next in line. We have sovereign wealth funds and then family offices as well.
And do you get any sense of why it is that US investors put less emphasis on ESG factors than the rest of the world?
I think generally, especially Europe, has been a bit more advanced in terms of the ESG, on ESG, partly because I think there's a lot more North-based investors here, so I think there was a drive around this. But also because in the US, I think there was a lot more skepticism around ESG, and there was a lot more confusion around fiduciary duty breaches. So I think there's been a lot of thought around whether taking anything else than shareholder value or essentially financial returns into account would be a breach of fiduciary duty. And this came with the belief that ESG has no impact on, or might have a negative impact on financial returns. So because negative screening reduces your investment universe. But I think slowly, even in the US, there's a lot more understanding around that it depends on the ESG strategies that are used. Even within negative screening, I think depending on how it's applied, um, the impact on returns is not that clear that it's always negative. And more academic evidence essentially suggests that generally um, following firms with better ESG performance leads also to better financial returns. Yeah. So,
okay. Thank you very much. Thank you, Amir. Thank you for an insightful presentation. I think it makes us understand this landscape better. Thank you, Robert. Thank you for chairing this webinar. Next week, join us with Tony Gida on machine learning in equity investment. And I'll see you next week.
thank you.